Bring that ass back like a boom, 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 boom.
All right, guys. So moving on to the market internals and VIX, let's just start talking about the advanced decline lines. And I'm a huge fan of this, trying to understand how the market is acting and whether we find more stocks participating in the moves of the market. So the first thing I want to do is take a look at the spiders. And the thing that you all notice is that although the spiders haven't made a new low, so to speak, the you see it held the perfect bottom right here. Uh, the advanced decline lines keep dropping. Now, I mentioned in our market overview that we are at neutral because we are seeing some advanced decline lines moving up. Stock participation started to move up, but we are still nowhere near breaking at least the trend line on the advanced decline line. And if you draw a trend line right here, you will see that we are still not there. Even if you are being a little bit, how to say, more lenient towards S&P 500 advanced decline line, you will see that we are still not breaking those trend lines on the advanced decline line. So there's still some work to be done right here. Now, moving down to the NASDAQ QQQ, NASDAQ actually is acting a little bit better in relationship to its advanced decline line. So this might suggest that S&P 500 is actually acting, well, let's just put it this way. It's the advanced decline line does not agree to the price action. So advanced decline line suggests there's more weakness underneath if it's making new lows, but price is not. That basically tells you that a large stocks or a couple of individual stocks are actually holding up S&P 500 more than it should be. Now, as far as QQQ, QQ has been going on a downtrend ever since, what is it? Almost the beginning of 2021. And if you are drawing against slopes, you will see that the slope has been going steeper and steeper downwards. However, one thing that we are noticing here is that finally price is catching up to the advanced decline line. So we are making a new low on price and the advanced decline line is making a new low. So that tells us that right now the market is in correspondence with what the stocks are doing. So this is the first major point of where we can start talking about base formations. Dow Jones Industrial, and it's really not that important to look at Dow Jones because there's only about 30 stocks or so in it. What is really important to know is that advanced decline line is actually holding higher than prices. So this might be a little bit of a overreaction from the market. So Dow Jones is actually in good shape according to the advanced decline line. So actually stocks are doing better than what the price action is telling us. And last but not least, IWM. IWM has been really consistent with regards to advanced decline lines. However, there's one thing to notice, same thing is happening here with the spiders. IWM is actually holding up better than QQQ, the spiders right now, this base formation. As you can see, we are at a point where we can talk about breaking some sort of a channel, horizontal channel, and I'll just draw it for educational purposes, right here. See, if we negate those stops above the channel right here, we have a pretty tight formation right here, and IWM is about to break this out. Something that we are definitely not seeing with the other indices. But if we're talking about breaking out of a horizontal channel right here, advanced decline line just went back into this formation right here. So advanced decline line is not supporting a break to the upside of the IWM. That's all that it's telling me. Now, if we're looking at the put call ratio, good thing for me at least is that the put call ratio is still going up where the market is making a bottom. We need to set ourselves in this region between 1 and 0.8, 0.75 in order to be okay. and at least normalize in relationship to what the market has been going through for the last 2 years and prior to that. Another thing that I want to show you here, and I don't know if you've ever seen this. Now, this chart might look a little bit confusing to you at first sight, but let me guide you through it, and you will see that we have a tool that is very predicative of what the market is going to do. So on top, this top graphic right here shows you 4 lines within some channels. So I have a channel set at 70, 80 as an extreme level, 30 and 20 as a bottom extreme level. What those 4 lines are the percentage of stocks above their respective moving average. Now you can go with 1 or 2 lines. I have all 4 of them here, but they go as they are. Now the white line right here and here at the bottom is the percentage of stocks above their 10-day moving average. The green line is the percentage of stocks above their 20-day moving average. Sorry for rambling here. The yellow line is the percentage of stocks above their 50-day moving average, and the purple one is the 200-day moving average. Now you can see that the purple line, or the percentage of stocks, this is all stocks traded on United States stock exchanges. It's not NASDAQ, S&P, or Dow Jones, or IWM, or whatever. This is all stocks. Now, as you can see, the purple line has been dropping. So the percentage of stocks above their 200-day moving average right now, as it stands, it's on 2620. Let me just get my pointer. Is on 2622. So 26.22% of all stocks are above their 200-day moving average, and that's terrible. Also, here you can notice 47% of all stocks are above their 10-day moving average, 37% above their 20-day moving average, and you cannot see here, it's below this, behind this purple notification for the 200-day moving average. Here, the middle section of the chart, we have stochastic slow. Now, what is important to note here, you can go without one of the lines if you don't want to plot it. This is just the standard stochastic slow. There's no different type of parameters. In fact, let me just click it so you can see it. So we have stochastic length at 14, smoothing 1 is on 3, smoothing 2 is on 3. Then we have oversold over both at 20 and 8. So it's absolutely basic stochastics slow indicator, as you can see here. That's straight statement, but you see it everywhere. And on the bottom chart, on the bottom part of the chart, I have S&P 500. So what you will see here, and I'll just draw some horizontal lines for you. So not horizontal, but vertical lines, so you know what I'm talking about. Every time that we see the 20 and the 10-day percentage of stocks moving below 30. I usually use 30, but 20 is an extreme level. And stochastic slow is oversold to the bottom, right here. You can expect the market bounce. So we had it here, so it dropped below the 20. That's a really strong sign. You have it like right here. You have it right here. We almost did it right here. You have it right here, right here. You have it right here. This one doesn't count, although almost touched it, but well, it moved below 30. As I said, I use 30 as a reference point, but 20 is an absolute extreme. So just do here, I'll just do here. This one's the 30, this one's the 20. So every single time this one dropped below the 20-day, the 20 threshold, 20% threshold, the 10 and the 20 percentage of stocks moving above their respective moving average. So every single time we had these lines crossing the 20% threshold to the downside and our indicator was on the oversold, we've seen bottoming in the market. Now, I'm not saying that this is going to happen now. I'm just saying this is what the indicator is telling us. On the other side, every single time we've touched every single time we've touched the 70 line, and this is that just shows you that there's not enough strength in the market. Usually when the market is on to the upside or the market is really strong, we're going to see, we just see, yeah, you can see right here that we've been actually seeing this from 2021. It's touching the 80s, and as you can see, if we have touch of the 80 threshold, and then we have an overbought reading right here, then you can expect some drops. I'm not saying that it happens every single time. It doesn't drop every single time, but okay, let me just place it right here. So you see, our indication is suggesting that the market could top. It still moved a couple of days to the upside and then drop. Right here, let's just say that we hit it. We're suggesting a drop. It just dropped. It didn't drop majorly, but it dropped. Where else? So here and here, now we have only indications of going above 70, which is the mild overbought, so to speak. Right here we have one, right here we have two, we have three. And as you can see, the market is making some corrections. Right here, it made a correction, but you would have been stopped out. Obviously, here made a small correction. Here you'd have been stopped out. Here you had to wait. You had to wait. And I find this to be a relatively good indication of what the market is about to do. Now, as you can see right here, the moving averages are in the middle zone, so I'm feeling safe trading. Although again, as we said in the market overview and our risk vest model and tactical trading, you should be careful. I mean, use tight stop loss, don't load up on positions, be careful. This is giving me some confidence that the market is trying to do something productive. So I have some positions, as you saw, holding through the weekend, which has been rare as of recently, but this is giving me some confidence that I can do that. Again, small portions. Last but not least, let's look at VIX. The VIX signal worked again very well, and the big signal, as I said, is only working on S&P 500. So every single time we have, every single time we have the VIX moving above the two Bollinger Bands and then closing below it, and the S&P 500 doing the same thing, moving down outside of the two Bollinger Bands and closing within it, we have a buy signal. That's about it. There's nothing more, there's nothing less to it, and we are seeing VIX dropping significantly. Now I'm looking for S&P 500 to make a move to the mean and VIX make a move to the mean. If we can break below the mean, that means that the S&P is clear to take off. So basically, this is what I see in the market internals. There are some divergences, as I said, between advanced decline lines, especially for the IWM and the S&P 500, suggesting that this move in S&P 500 and IWM is a bit excessive. Basically, they're bouncing more than their internals are suggesting. But we'll see what happens next week. And now we're going to move to top and bottom industry groups. So in terms of top and bottom industry groups, we are using O'Neill's qualification 197 group. And their relative strength compared to 6 months ago, 3 months ago, last week, and this week. So as you can see, basically there's absolutely no change from last week. This week it's dominated by oil and energy, with some media periodicals showing up here, but it's pretty much exactly the same thing. Now, when we do that in analysis, we also want to note what groups are moving up and what groups are moving down from last week and below prior periods. Now, one thing that you can notice here, these are the upside movers, so basically they are moving up the relative strength letters. You can see food, aerospace and defense, steel producer, of course, minerals coming from Russia. And again, food, the biggest jump was made by utility gas distribution companies. And when we're speaking about the worst industry groups, we are still in the region of XLK, computers, and XLC communication. So we have retail, internet, software development, software-specific entrepreneurs. We also have software medical computers, software educational media, and some other like consumer electronics and home furnishings. So basically things that people don't consider really important when we're talking about uncertainties and life-threatening events. And you can also see this in the groups that are moving to the downside. So basically, notable movers to the downside, the two largest groups that have seen a drop from last week to this week in terms of relative strength and price performance are retail and jewelry, and the other one is later in travel booking. So basically, the travel booking and the retail jewelry are taking a hit. Other things that I actually find interesting are chemicals and plastics are taking a hit, and then we also have machinery and auto truck tires, miscellaneous and building construction, transportation and logistics are also. Now, with that being said, so take a note that some of the transportation services, especially naval transportation services like NMM, like bulk transportation, like ZIM, like Danos, are actually setting up to go higher. So this might very well change. Last but not least, we also want to pay attention to the geopolitical tensions that are going around us. And you cannot really omit Russia and Ukraine. I don't want to talk in length about this conflict. All I really feel needs to be said here is that wars are unnecessary. They don't serve a purpose, so to speak, and the only outcome that comes out of wars is plain human suffering, which I don't just see a justification for that. What is also creating some uncertainty regarding this conflict is NATO, that has been sort of ununified, weak in their response. European Union as well. United States are imposing some sanctions, just as European Union is, but uh, for some, this has been a conflict that NATO and European Union, in partnership with the United States, should have been way firmer in their response. Another part is that China has been switching their opinion a couple of times in the last week. Some saying that this is only Russia's matters and we should not interfere. Then supporting and saying that they are going to buy some food and grain products from Russia, then switching their opinion and saying that there should be peace and there should be negotiations, ultimately blaming the United States. And, I'm like, what? But China has been acting sort of in between, trying to balance it, and also trying to raise concerns in their relationship with Taiwan, because there have been some fighter jets moving in and out of Taiwan, the Chinese fighter jets moving in and out of Taiwan airspace, and that's creating more pressure. And I think that the market is trying to find its place within that geopolitical uncertainties, and the Fed hikes also affect this. But as it pertains to the Fed hikes, I think that the market is pretty much over with. Probably not the whole thing is priced in, because we are still getting some news that now we might have some postponement in the rate hikes because of these geopolitical tensions. We still don't know, but I think that the market now has really accepted that the rate hikes are happening. Whether we like it or not, it doesn't really matter. The rate hikes are happening, and we should see some statements from the Feds coming in the weeks ahead. So the market, as I said, it's trying to improve. It's showing some signs that we might see actually consolidation here and moving higher, but still there's a large amount of looming uncertainty that is clouding our vision for the future so far. So in summary, guys, we still have our risk vest on sell. As I said, nothing really has changed. Yes, we had a couple of days that were actually really good days of buying, but nothing major so far. The setups are selective to now. We still have some setups that I'm looking at. We saw some improvements since last week. Some stocks are actually setting up to go higher. We saw some breakouts this week that have actually held for a couple of days. The market is at the bottom side of the consolidation zones, especially in Nasdaq. But nevertheless, this is consolidation. We dipped price support zones and we bounced back above those support resistance lines. So I'm not going to say we're in good shape, but at least I'm saying we're not in broken shape. So we need to see what's going on. Put volume, as I said, the put call ratio. We're moving in this zone between 0.75 and 1, which is the standard zone prior to the COVID crash. So this is neutral. This is just getting to normal. This is getting to normal. Volatility, as we saw in the VIX signal, it's decreasing, which is good. And I really hope that we can sustain it below the 25 levels. We're still above 25, but below 30. So if we can go below 25 and sustain it there, that'd be really good for the market. And as I said, geopolitical tensions. Still, I believe that cash is the best position. If you are invested, try to limit it to about 20-25% of your available cash. Don't put anything big right now. We don't have that follow through day. Remember that we don't have the follow through day. And market is still at the bottom side trying to consolidate, but we are not safe from a breakdown and testing lower levels of support. So that was it from us for this week. There's more content coming your way. I hope you like it. If you have any questions, please feel free to chat with us all the time. We are in the chat all the time. And have a very, very, very nice Sunday. And I'll see you guys tomorrow in chat. Bye-bye.